Hello, wonderful people. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas. I'm the co host alongside Stephen Thomas, chief economist and founder of Reports in Housing. Today, we got some fun stuff to go over. We're going to talk about real estate, some recent good news on economics. I know that you and I both enjoy, thank goodness. Concerns over investors, home buying now versus later, AI in real estate, 50-year mortgages, and more. But first, Stephen, what is going on in your neck of the woods?
Well, what do we have going on here? So soccer is done for Zeke, and running is done for our freshman for cross country, but our senior continues on. She's the only one. Our flag football star, she's done. She was one of the MVPs for defense. It was pretty awesome. Go Athena. And then so we are down to CIF prelims this Saturday in the pouring Southern California rain. It's supposed to rain. It's supposed to rain like over an inch and a half. So that'll be interesting. It's a dirt course, so they have a rain alternate course. So they'll be running that, which is flat. The dirt course, they're known for their hills. So it's going to go from really hilly Mount Sac to a very flat Mount Sac. And so that's this weekend. And the next weekend, she runs again in the CIF finals. And then the following weekend, right after Thanksgiving, she runs at State, which is up in Fresno. So we've got cross country on our minds right now. We're going to be cheering on the running and all that good stuff. She's a senior, so this is the last hurrah for high school running cross country, but she's going to run cross country in college. So that's what's going on for us, and pull down all the scary Halloween stuff because you know what? The holiday market arrived. We'll talk more about that. And come that Thanksgiving week in a couple weeks, we'll be putting up all the festive Christmas holiday decorations. So there you go.
Well, it technically is Christmas already. It's November.
You're funny. You're skipping my favorite holiday, which is Thanksgiving. It is all about family and getting together and being thankful, and without presents. So I kind of dig it. I think it's a great holiday.
But
How
what's
about
been
you?
happening?
What's
What was
going
that?
on for you? I need to know what's going on for Brennan Joseph.
Honestly, not much. Just been training more for the marathon. It's actually been getting a lot easier. I am not dreading running as much. I'm able to go out and enjoy and not feel like I'm out of breath every single second that I'm out there. But that's been going well. Sports, I'm not gonna dig too deep on that. I don't want to jinx anything. That's been going fine. I'm not gonna say much more about that.
Go Ducks.
Yeah, exactly. Go Ducks. Outside of that, yeah, went to a concert this past weekend in Universal Studios. It's been a busy couple of weeks, but I am glad it's starting to slow down right before the hectic holidays, is how I sort of see it. It's fun to be around family. I know it's going to feel like everything's sort of speeding up, especially as we ring in the new year, but I'm excited to see how this year closes, especially on the real estate side with our improved mortgage rates and everything going on. So we've got some tricky couple months ahead, and I'm curious to see how things sort of lay out. But Stephen, what's been happening in the real estate world as of today with supply demand and our very own expected market time over the past couple
Well,
of weeks?
yeah, you can already feel that we're in the holiday market. As soon as Halloween's done, boom, that is a big indicator where everybody puts down their Halloween decorations and says they kind of figure out, oh, if they've been on the market for a while, they start pulling their homes off the market. Fewer homes come on the market, and we watch inventories drop. So inventories have been dropping at a pretty rapid clip, but within like the last week to week and a half, we've actually seen, since October 31st, we've actually seen a pretty decent drop in demand, and that had more to do with not necessarily that demand should have dropped it that much. I think it has a little bit more to do with these government shutdown, because we have rates that are better than we were last year, and it should have driven a little bit more pending sales activity. The reason we feel that it didn't is because, and we'll see that in the numbers working out, is because of the government shutdown. There was economic uncertainty began to rise, and when economic uncertainty rises and people they're starting to be fearful of job loss and things like that, they don't do as much. They're not moving as much. But lower rates kind of like pushes people that have had great jobs and nothing, they have nothing to worry about to purchase. But the government shutdown just adds an extra element of economic uncertainty, and so we're actually seeing a little bit more of a dip in demand than we'd ordinarily see. But demand and supply are going down at the same rate, which is actually atypical for a holiday market. So that the market, if you have demand and inventory going down at the same clip, which is and it goes down fast during the holidays, we actually then see that the market time remains pretty much the same because you have supply and demand dipping at a similar pace. But what we've been anticipating is, because the interest rates are way better than they were a year ago, and they're the best point of this year, that we would actually get a little bit more demand. So supply goes down faster than demand, and the actual overall market improves. We've seen that in some of the markets. It's just not all the markets across the U.S., and that has more to do, like I said, of the government shutdown. But we have great news. The great news of President Trump actually signed off this morning on the government shutdown is officially over. Yesterday was the 43rd day, so technically we're at the 44th day. We hit it in the morning, and now government is being reopened, which is huge because we need to get our data. We've been operating in the dark. Everybody's been looking at private data, and they've been trying to decipher it. And I have heard some people, even from CNBC, like, this has made us look the other way, and we can look at other stuff. And you know what? I just don't buy it. It's not going to move the markets as much as the government data. Government data has had a black eye, but they're very, very transparent. They just have inadequate number of surveys that are coming back. So there's been a lot of revisions. But that goes away as they do the revisions. It's because they're really transparent. They get more and more data coming in, and then they're able to cross-reference it with other unemployment data and things like that. And they can come up with a real solid jobs and report. And it takes about a year for it to be really solid. But we want our monthly numbers. We'll take it all with a grain of salt. It says estimate at the top. So we are the gold standard around around the world, and that's it. So we are the gold standard. Yes, it's not as good as it was 10 years ago, but the budgets haven't changed from 10 years ago. Improve those budgets, and we can be a little bit less antiquated and maybe change the way that we gather the numbers so that we can continue our gold standard that doesn't deteriorate over time. That's really what the issue is there. But we've turned it back on, so we should be getting a jobs report next week, which will be important. That will be for the month of September. I don't think we're ever going to get a jobs report for October because there was nobody collecting data. So October is going to be a big hole. So we're going to have to wait until the start of December to get November data. And I don't even know if we're going to get all of that because here we are. We're already the middle of the month of November. So I don't even know what the timeline is going to look like. They're going to tell us what that timeline looks like. But at least you can turn back on the data so that they can start collecting and doing their due diligence. But it's going to be taken with a giant grain of salt because there aren't that many days left of November for them to be doing everything that they normally do. So we'll see. Yet to be seen how it all plays out. But from here, I actually, now that we're opened up, and if we get data that pushes rates down a little bit further, because we've been stuck right around the same level, about 6.25 all the way up to 6.39, I think it got to, and it's just been stuck there ever since the government shutdown. But that's a long time because that's a month and a half being stuck. So it was making its way down since the end of May all the way towards, looks like it was going to continue to go down towards 6%. And then our data was shut off, and that's why it went sideways. We need the data to be turned on. It doesn't look like we're going to get much more movement down until we get to the month of December. We'll just all have to wait and see and wait until all that data comes out to better understand exactly where we're at. So that's what's going on for the economy and the housing market and all that good stuff.
Well, thank you for that update. It's good to know.
Oh, yeah. Oh, one more thing. We're supposed to get an inflation data point today, but we didn't get it because the government was shut down.
Of course. We had to miss at least one more thing. But at least it's open now. We have things to look forward to, and hopefully rates will move in the direction that they are supposed to, which we'll see as the data comes out. Just how they work, and back to normal. That's what it sort of feels like, at least in a couple months. So what I wanted to ask you first is, who's the real problem about? Mom and pop investors or large institutional investors, or foreign investors for that sake? This is a discussion that's continued for years, but still needs to be talked about because it's always brought up that investors are driving up home prices. They're purchasing all over the place, making things unaffordable. What are you actually seeing? Does this have any validity?
Yeah, so foreign investors make up a tiny little portion of the overall purchases. And a matter of fact, it really came down to a low last year, 2024. It's bumped up from that real low. You have to go dial backwards a few years to actually see there was a lot of foreign purchases, but it really hit a bottom. And that last year, 2024, was the lowest number of foreign purchasers, and some of them are purchasing them for sale, some of them for investments, but the numbers are really small. This year it's bouncing off of that low bottom, but it's still really low. And so that's foreigners. So let's put that aside. As far as institutional investors are concerned, those are the big behemoths. That's where you get the where everybody says it's Blackstone. It's actually BlackRock, but and a whole bunch of other investors. There's these big giant behemoths in Wall Street that purchase these big swatches of real estate, and they're going to buy up all of the real estate in the United States. And it's actually a tiniest little sliver of purchases. Now there are areas along the Sun Belt is where they all are at, so you can actually get into a community, or then when you drill down to the neighborhood, where there's a disproportionate number in a neighborhood. That's a totally different story, but that there should probably be some legislation around that, but who knows? In certain pockets where you see too much institutional, but there actually have been net sellers. If you look at all the statistics show that they're actually selling more than they're purchasing right now. So they're net sellers. Who you should be really concerned about are the mom and pop investors. And the mom and pop investors are, there is a growing number of homeowners that place their homes on the market, and then after not being successful because they didn't get their price and terms or a necessary offer or an offer at all. Typically, there's a lot of homes that have delisted. Used to be called expired. That's not a good term. That sounds like they died. But instead, delisted is the new term. And delisting, there are a great number of homes that have been pulled off the market, delisted compared to last year. And it's even elevated compared to where we were prior to the pandemic. And the reason for that is because they don't really have to sell. Now, if they still want to move, 12% of everybody that pulls their homes off the market is strongly considering renting out their home, which means they become landlords. And if they've never been a landlord before, it's because they have this low fixed payment, and they look at how much they can rent their place for, and they go, oh, that's juicy. And they go ahead and rent out their place and go do whatever they need to do real estate wise someplace else. They can even pull some of their money out and invest it in something else, their next house. So that's who I'm most concerned about, are actually the mom and pop investors and that growing cohort, especially the people with the lower mortgage interest rates. There are, like here in California, 28%, and it's one of the highs. But everywhere else, it's like 1 out of every 5 have an interest rate below 3% or lower. That's pretty huge across the U.S. Now, for California, it's 28% have an interest rate at 3% or lower. And we're talking giant numbers. And we're talking leases that, the lease amounts that far exceed what they're paying on a monthly basis. So that delta, that net they can turn that into a little bit of income that they generate on a monthly basis to offset whatever they're purchasing. So that's the subset that I'm most worried about, and the only thing that fixes that are if rates come down enough. So we're watching carefully like everybody else.
So I wanted to ask you the difference between purchasing during these next few months, so the holiday market, and the difference between that and the spring market. What's the full difference between waiting to purchase or purchasing today?
So I'm going to give the lay of the land for what the holiday market is. That's where supply plunges and demand plunges. So the fewest number of pending sales actually occur in the month of December, and they start to really slow down when Thanksgiving. So it's like because it's the last week in November. So we have like 5 weeks of a real material slowdown in our marketplace where a lot of people pull their homes off the market. The fewest number of homes come on the market in December and the second fewest in November. So there's a lack of real fresh properties. But do understand this. This is a window of opportunity right now to purchase for buyers. And that is because we have these low interest rates. It's the lowest interest rates where we've been below 6.5%. So it's been between 6 and 6.5 now for 70 days as of the recording of this on November 13th, Thursday. So that's a long time, 70 days. Last year, we were at 45 days. This is much more longer with duration, and we anticipate the base case is that next year, to start off the year and match up with our spring, we'll have the same thing, which means busier spring than anybody has seen for several years. And it's kind of like this extra inventory and there was extra competition kind of snuck up on us. And then all of a sudden it was sluggish. It'll be the opposite. Come this spring with these lower rates, it's going to be busier in the spring and it's going to sneak up on us. Not us, because we know that this is the direction it goes if we have rates below 6.5%, because we haven't had that match up with our spring in the last couple of years. So we know that once we get there, that it's going to really materially change our market. And there is even a possibility, asterisk, but possibility, the second case beyond our base case is actually for rates to dip slightly below 6% if the job market breaks. If the job market breaks, Fed's all in. They're going to be cutting rates, and the 10-year Treasury and mortgage-backed securities interest rates will already go down prior to that, and we'll see rates dip underneath of 6%. And it's going to be very hard to get high anyways in above 6.5 and into the 7% where we've been hanging out before, because the spread's gotten so much better as well. So all of these together mean that we're going to have these low rates, and there's even the possibility of being below 6, which means that it's going to be busier. When, as a buyer, do you want to play? Do you want to play right now when there are some homes on the market that have been languishing on the market for months and they're ready to negotiate anything that comes in? It's not the ones that sell like instantaneously. You got to go to the ones that have been sitting on the market for some time, and those are the people that are willing to deal. You today, as a buyer, can most likely get a seller to pay a point in a point up front will bring down that interest rate fixed forever. It's not like a buy down, like a 2-1 buy down or something like that. That is a fixed rate, and you pay a point. You can get underneath of 6% now, and you can get them to pay it. Good luck on doing that in the spring when all of a sudden it's busier. I told you it'll sneak up on us. So when do you go? You go now, and that's kind of what we're articulating out there. But we're only one small voice compared to we're like a whisper compared to the loud screaming megaphone of YouTube and all the negativity that's out there. And then they're going to be like scratching their heads, wondering why in the world did the real estate market rekindle, and that's where it sneaks up on us. So we do the math. When is that window of opportunity? Right now through the end of the year.
And you've said that a lot, even going back to 2019. And how did that turn out?
Yeah. Yeah, well, I did say that in 2019. That turned out great for myself. My wife actually said, hey, there's this economist that said, hey, why don't you purchase? I heard it's a really good time to purchase right now. And this is a window of opportunity, this right now, because you get some people that have been on the market for a while and they've been hanging out for a while. This is the time to go, and it's a window of opportunity. And so we actually took that window of opportunity in 2019 and pulled the trigger and never looked back. So that's what we have been saying it since about 2019. You're correct.
So the first time homebuyer share falls to historic lows of 21%, as well as the median age rising to 40%. So this is according to the National Association of Realtors. What do these metrics tell us about the future of housing? Is this a large concern? Because I've seen a flood of articles, flood of people talking about this. Like, this is X, Y, and Z. This is all because of boomers. This is all because of these different things. What's your actual take on the reason why these metrics are lining up the way that it is?
Yeah, you have to take this one with a grain of salt. This is National Association of Realtors. Love a lot of their data, love a lot of what they do. This is a survey, and the survey is like is like they ask like 2 trillion questions. Now, who in the world is going to take the time to answer the 2 trillion questions? Not a lot of people, and it's going to be geared more. It's not going to be the younger cohort. Those aren't the people that are inclined to do it. These millennials and Gen Zs, they're not going to answer that kind of thing. That's just a waste of time. So this needs to be taken with a giant grain of salt. I actually don't quite believe it. Yes, the median, it's probably closer to around 32, 33 where it's been. It doesn't go from 32 to 33 and go to 40 in a year. That's not how it works. So take this with a giant grain of salt. I love National Association of Realtors data. I just don't like this survey and a lot of surveys. This just shows you why survey work has holes in it, and there's a lot of room for error. And this just shows you there's too much error in this.
And on the topic of AI, how large of an impact do you see it having on real estate? I know people have brought it up at your presentations and you've heard about these different things. Is it really going to have as much of an impact as people say that it can?
Yeah, I don't think we're going to see it have. It's actually an enhancer. That's the way I look at it, as an enhancer, and it will enhance what anybody does. It enhances what we do. We use AI to help us build Excel spreadsheets and things like that. So, it helps with if you need to think about various different topics to look at and stuff. It's interesting, and it'll help you out with great pictures and things like that. So it's just a value add. It's not going to replace anything with real estate, that's for sure. And there's not going to be robots showing people property and all that stuff. Now, when you make this gigantic purchase, the biggest purchase of your lives, you need to be working with a human being. So I just see it as an absolute enhancer. It's not a total game changer where, oh my gosh, this is amazing. It's gonna totally change the industry completely. It's just gonna make it a lot better, a lot more efficient. It's not like when we all of a sudden went from, we used to have MLS books, multiple listing service books, where it came out once a month, and there was in 2 weeks you got an insert, so it took forever to see new things that were coming on the market. Now, with the adoption of the internet, that was a giant game changer, because now the multiple listing services could go online. So that's been the biggest. That was the biggest change. And yes, this will just be an absolute enhancer. So you embrace it, and it's going to definitely help out people's businesses and streamline it and make people more efficient.
And finally, to end today's fun episode, something that we've heard about a lot, obviously, over the last week, and I know you're going to do a YouTube debrief video on this. There's been lots of discussion over the 50-year mortgage. Is it possible? What are the flaws? And what is reports on housing's take on this sort of mortgage?
Yeah, I heard from one. I was speaking last night in the City of Industry, Los Angeles, and there was somebody that came up to me and said, "Well, I kind of like the 50-year mortgage because you don't stay in your house forever, and it allows you to have a payment that is a couple $100 cheaper per month, and it's just a way to get in, and you're not going to stay in there forever." And I just don't like it for a variety of different reasons. I would rather wait for rates to come down 0.5%, because that will be the difference. Now you have a 30-year mortgage at that same amount as the 50-year mortgage. The problem with the 50-year mortgage is, if you look at the amortization schedule, you are paying a boatload in interest, a boatload, just too much. You could see the difference between when we went from 15-year mortgages to 30. That was a boatload more, but going from 30 to 50, wow, you should see the delta, the change between the two. It is gigantic. And I'm actually going to do a housing debrief, a video on it completely, so that you can see what the numbers really look like. Because while it sounds good on paper, you really need to do the number search and see what you actually have to wait for. I'd rather get somebody to pay a point so I could bring down my rate enough so that I will be making that savings and not and have my home paid off in 30 years. You could throw in an extra payment here and there and here and there, and the next thing you know, you can pay that. You can pay off the mortgage in 20 years. It's really it's not that hard to do. If you have extra money lying around, you can actually do that, and you're cutting down the time to where the loan is totally paid off. So I'm for that. We'll do this. We'll dissect it completely. I am not for it at all. I think it is. I'm glad they're talking about solutions. This sounds great. I mean, at least we're talking about solutions, and we got to look at that. On the face of it, we've got to think of different things. Portability of mortgages, that's being floated around. I think that's a real possibility. That's something that we need to talk about a little bit more. But the 50-year mortgage, that's just not going to get off the ground. It got too much flack. They've already walked it back, but it's out there in the air right now. Everybody's talking about it across the United States, like as if it's going to happen. They've already walked it back because there was enough of really intelligent people that said not a good idea.
Exactly. Well, thank you everyone again for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry or in the economy, you can check out our YouTube, or if you want to watch the 50-year mortgage video, I'm sure we're going to have that up tomorrow evening, and that will be plenty of information. Or you can subscribe today at reportsonhousing.com. Please leave us a good review. We'd always appreciate it. If you have any questions, we can always answer it here. We are here for you guys. We're here to answer your questions, and we are very thankful that you're listening to us. So have a great rest of your day, and we will see you very soon. Thank you.
Thank you.